I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is February 15th.
And this is your interest rate update. We're also going to cover some important inflation information.
All right, remember, this is for informational purposes only. This is not financial advice. And if you like what we're doing, be sure to click that subscribe, comment, and like. If you put a comment in there, if you have a loan scenario or any questions, we'll be sure to respond right away. We love responding to the comments, and so be sure to do that.
That's what makes our day.
Okay, so inflation came out yesterday, February 14th. It was an anticipated, report, and it was so February 14th. Inflation came out. It's the year over year. It's the January 2023 inflation versus the January 2022 inflation number.
That's right. And these come out once a month. And people haven't been as interested in inflation, I would say, to the last, call it 6 months. It really became an issue about 9 months ago, but it took several months for people to start recognizing, oh, it's impacting our economy, isn't it?
Absolutely. I mean, here we go. We have the inflation. There's two inflation reports. One's the inflation, the standard inflation without energy and food, and then the other is the core inflation that shows you what inflation is with the energy. So that'd be like gas, the gas and oil with food, and so that's called core inflation. Standard inflation was last month was 6.5%. So that was the December. Mm-hmm. The numbers were expected for January to be 6.3. They came in a little bit higher at 6.4.
Yeah, and people may say 6.4. Well, that's pretty close to the forecast, isn't it? It is, but remember, our numbers on an annual basis should be 2%. That's what the feds are targeting, is that we should have inflation on a year-over-year basis of about 2%.
Right. They want this number not to be 6.4, but to 2. And of course, that's why they've been so aggressive on the Fed.
Yeah, so if
the Fed rate.
Right. So if someone said, hey, you're 300% higher than what you should be, you'd be like, oh, or what is that? That's 300%. That is something that the feds are taking very, very serious.
So what's important about the forecast, everybody's setting, all the banks, all the traders are thinking 6.5 or 6.3%. Well, it disappointed, right? It was a little bit higher. 2 weeks ago, also the unemployment number came in much higher than anticipated. So we saw interest rates increase. But overall, what this means is maybe inflation's not done. Maybe this is going to heat up. Maybe we're not done with inflation. We've all been to the store lately. Just a couple days ago, again, I'm shopping and I just see stuff just from last week increase.
Mm-hmm. Yeah, inflation can be very resilient. So what they've talked about is even when they're done raising, they're not going to instantly just pivot and start reducing. They're going to hold that interest rate, at its level for a certain period of time. I'm guessing what we're hearing is 4-6, months ish, so that they can make sure that inflation fire is truly tapped out.
All right, so let's look at what the 10-year bond market. We also call it the 10-year Treasury. This is closely tracked in Wall Street, but also mortgages. This is what everyone looks at is the 10-year Treasury, and so it's very relevant. This trades every second of every opening market day, whereas mortgages are not. They're not fluid. A 30-year fixed mortgage is moving around a couple times a day, and it's as a result of what's happening right here on this chart.
Yeah, and I tell people, I don't know if we have time right now, but these mortgage rates move in 1/8 increments, which are huge increments for the bond. So what this bond is showing you is what's happening in between those big interest rate, not gaps, but those big interest rate increments.
Yeah.
So yeah, there's billions of dollars in this market, and let me tell you, they know exactly what they want to be buying and what they want to be selling, and that just moves the needle.
So what are we looking at here? I mean, this chart, I'm just trying to give everybody perspective of basically what the numbers were from historically. Here at the end of this chart right here, this is where we're at today. In October 21st, that's when rates hit a high. October 21st, the 30-year fix was about 7% up here at this time. And then into December and into the new year, or really into January, we hit a low. It was January 18th and this February 2nd, we hit a low in the bond market. And so we also saw that same low in mortgage rates. But since February 2nd, it was February 3rd where the unemployment was released, And we have seen a continual rise in the 10-year and mortgage rates up 10%. So, meaning that they have increased about 10%.
And a lot of people will say, well, okay, I thought low unemployment is a good thing. It is a good thing. But when the feds are trying to stamp out inflation, the good news is the bad news theme is what takes over. And Jerome Powell spoke, and then a few days later, those employment numbers came out, and it totally caught him off guard. Yeah. So because those numbers were so strong, they thought, uh-oh, the feds aren't done. The feds may even do more than we think. And then that's when you start seeing that bond go up.
So we may see, the rest of this month is, we'll see what happens as far as economic data, but we're going to be waiting for the Fed to speak in March, but also the inflation. We have to wait another month, and the unemployment numbers coming out in the first week of March. So there's for the next couple of weeks, we could see things stay about here or even trend up higher. Maybe they retrace back, but we'll see.
One thing is for sure is that nothing moves in a straight line. And even though we have this, what we call the interest rate slide in a straight line, we're simply averaging out what it's done over the past, 35 years or so. But it's very typical for there to be an overreaction on both the downside and the upside, which is why you see these undulations going up and down. No investor moves in just a straight line.
Yeah. So this is the 50-year history of the 30-year fixed. And what you wanted to see is for that 35-year period, we were kind of stuck in this lower channel and bouncing off of this trend line. And we busted out of that in the spring of 2022. Now there's a lot, that's a whole nother video to go over, is why we were continually seeing a decrease in the interest rates, but it really gets tied to the debt, right? The US debt and the policies that were put in place. But what I wanted to do is just show a big, large perspective of the 30-year fix. Where are they going to go? Just like, what would that look like? And this is kind of where we, at the Mortgage Brothers team, where we see rates going, just based off of everything that we've been reading and how we really feel. That we do feel that interest rates, if you were just to see this, our little line over here.
Yeah, I like the little horizontal piece you have there. That represents that not pivoting immediately.
Yeah. We should see between March and July, the idea is that the Fed's not going to do much. They're going to basically get on and be in a wait and see period and see how the market reacts. But overall, we do believe these rates will cause a slowdown, and the Fed will, the slowdown in inflation, slowdown maybe in the economy. When the Fed does their job, once they feel like their job is done, they're going to start lowering those rates. And it's anticipated towards the end of 2023 into 2024. And the mortgage rates will follow. So let's get into where the rates are today. The 30-year fixed, we see at 6.5% today, the 15-year fix at 5.875.
The 30-year FHA, 5.99. The 30-year VA, 5.99.
Those interest rates are based off of these loan assumptions for conventional FHA and VA loans. They're very standard scenarios, and they come with no extra points. No extra fees.
No extra fees. If you do need an interest rate lower than what we were quoting, then there are options in which you can do what we call a buy down, and that would be having points. But what we just showed you comes with no points.
Yeah. We're mortgage brokers, and what we do is we look at we see a lot of loan scenarios that come in. We can tell you that 9 out of 10 times a mortgage broker is going to have lower rates with lower fees. If you see an interest rate that's similar to this, let's just say you're looking at a 30-year fix at 6.5%, it will most often have higher costs than it should. If you're going to a typical bank or typical lender, really 9 out of 10 times, you're going to see a rate that's, if it is 6.5, it's going to have higher fees.
Yeah, we just quoted a borrower today, and we said, here's the interest rate, no points. And they responded back via text. What are no points? No points are just simply what lenders will charge sometimes for the interest rate they're quoting you.
So be sure to, if you want to have us review an estimate that you've received, or you want to talk about where your scenario looks like, and really any scenario you have, any comments in the comment section here, or you can email us as well. We'll get back to you right away.
All right. Hey, thank you, folks.
Take care, everybody.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.